Welcome back to Talk Tickers. We're your shortcut to understanding the big narratives moving the markets. And today, we're doing a deep dive into Nike Inc.'s Q1 fiscal 2026 earnings call. You know, if you had to give this call a theme, it might be something like, well, Schrödinger's earnings report. Bit of a mouthful, maybe, but seriously, on one hand, you saw this big stock surge, real proof points of their new strategy, the sport offense, tangible stuff, but then the other shoe dropped, right? A really cold financial reality check, massive and actually escalating margin pressure. It's going to hit the P&L hard next couple of quarters. So the core question I think that we need to unpack for you is, did management actually show enough evidence that these strategic wins, like, you know, that huge 20% growth in running, are they sustainable, scalable enough to make investors look past the, frankly, painful financial guidance?
That tension is exactly it. It's central to understanding why the market reacted the way it did. So our mission today really is to break down those headline results first, then dig into the foundations of this big organizational reset they're doing. And then, we have to confront that pretty staggering number attached to the new tariffs and figure out how they plan to navigate what they themselves are calling a nonlinear recovery.
Okay, right. Let's start with the good news then, the results that got the market excited initially. Because this wasn't just a beat, it felt more like a signal about execution. GAAP EPS landed at $0.49. Now, just for context, consensus was hovering around $0.27.
Yeah, that's almost an 80% beat on EPS.
Huge.
It is. And that kind of over-delivery on the bottom line, it's a big psychological win, and it shows that the cost-cutting, the inventory cleanup they've been doing for the past year, finally paying off down there.
And the top line, revenue.
Revenue also beat, came in at $11.7 billion. Consensus was closer to $11.0 billion, so the 6% beat there too.
Okay, so reported year-over-year growth was, let's say, modest, plus 1%, or actually negative 1% if you strip out currency effects.
Right. But in this environment, that still signals some stabilization.
Definitely. So where were those specific bright spots? Management highlighted a few areas as like early wins for their strategy, right?
They did. They pointed to 3 clear momentum areas.
Okay.
First, that successful reignition in running product we mentioned. Second, strong growth in North America, which is up 4%. And third, importantly, a really robust return to health in their wholesale channel. That grew 7% overall.
Okay, wholesale up 7%. That shows that pivot away from just focusing purely on direct-to-consumer seems to be working, at least partially.
It seems to be bearing some fruit, yeah.
But hang on. Before we get too carried away with the EPS beat, let's talk about the big red flag. Even in this quote-unquote winning quarter, the structural strain was just undeniable. Gross margin. It dropped 320 basis points year over year, landed at 42.2%. What does a drop that steep really tell us, even with a strong EPS number?
Well, it tells you they're doing a great job on SG&A, on cost control. They're executing there exceptionally well. But the core profitability of the product itself, that's under immense pressure. That 320 basis point drop, it signals kind of a perfect storm brewing. You've got channel mix shifts, you've got necessary inventory clearance, and critically, you're seeing the initial hit from those higher North America tariffs starting to bite.
Right.
So it really highlights this massive structural weakness they're trying to manage, maybe mask a bit, with operational efficiency gains elsewhere.
Okay, that really sets the stage then for the main story of the call. This strategic pivot they're calling the spurt offense.
Yep.
CEO Elliott Hill, he's clearly trying to implement these pretty fundamental changes, big organizational shifts needed for, profitable organic growth. And it involves realigning about 8,000 teammates. I mean, let's be frank, reorganizing 8,000 people, that's high risk. What's the actual goal?
Oh, the risk is enormous, you're right. But the potential structural reward, if they pull it off, it could be game-changing. They're basically moving away from the old way they were structured. Remember, they used to be siloed by men's, women's, kids.
Right, by gender.
Exactly. Now they're aligning Nike, Jordan, and Converse around specific sport categories. So they're trying to organize around how consumers actually experience sport. The goal is athlete-led innovation, basically, driving sharper product, better storytelling, with a really specific focus, whether that's running, basketball, training, whatever.
So creating like micro businesses within the bigger company.
You could think of it that way. Hill is essentially laying the foundation for future organic growth, moving the company from defense to a more controlled offense.
And luckily for investors, they actually have a template that's already working. You mentioned it, running. That category grew over 20% in the quarter.
Yeah, huge number.
So how did they do that? And why is that the model now?
It's the playbook they want to copy everywhere else. They went really deep on consumer insights. Found runners basically want one of three things: big cushioning, stability, or maximum energy return. Simple enough, right?
Seems logical.
So then they immediately overhauled their key franchises, the Vomero, the Structure, the Pegasus, redesigned them to hit those three distinct needs.
Okay. So distinct product silos, clear price points within them, and then just relentless innovation flow.
Precisely. They committed to it. At least one new major footwear style each season across those core silos. That structure, that consistent innovation, that's what powered the 20% growth. And management confirmed on the call, the plan is to apply that exact playbook segmentation, consistent innovation to categories like global football starting now.
Makes sense, especially with the 2026 World Cup on the horizon. And we're already seeing some of that, right? The new Phantom 6 boot is out now.
Yep, and a new Tiempo coming in Q3, new Mercurial in Q4.
So it's that steady drumbeat of new stuff across the major sports. Okay. But moving beyond just the product, the channel strategy is also getting a massive overhaul. And this is where you see some of that short-term pain we talked about. You said wholesale grew strongly, 7%. But Nike direct their own stores and website that actually declined 4%. And digital, their e-commerce, was down a steep 12%. So why is success in wholesale happening while their own prized digital channel is shrinking?
Well, this might be the clearest sign that management is prioritizing long-term brand health over just chasing short-term sales volume. They made a strategic call, a tough one probably, to drastically cut reliance on some of those classic high-volume shoes like the Dunk. And they got really aggressive cutting promotions.
How aggressive?
They said they cut promotional days by over 50% just in North America.
Wow, okay.
So that 12% drop in digital, their e-commerce site, that's the direct result of that pruning. They're actively trying to reposition digital as a full-price, healthy business. And they're willing to accept that. Short-term organic traffic is going to slow down because of it.
You know, it's interesting that Nike Direct overall, which includes physical stores, only declined 4%, while digital alone was down 12%.
Right. That concerns, it's really the e-commerce part bearing the brunt of this deliberate cleanup effort. They're trying to protect brand equity.
It's a huge gamble, though. They basically admitted they expected double-digit organic traffic declines, just accepting that loss of volume to reset pricing. But we also heard that expanding distribution elsewhere is helping North America's overall 4% growth, specifically that launch of the Nike brand store on Amazon. That's a pretty big olive branch to partners, isn't it?
It is. I think they realized, maybe the hard way, that to elevate the whole marketplace and protect margins long term, they need key strategic partners. So the Amazon store launch, it contributes to growth by meeting consumers where they already are, instead of trying to force everyone through their own digital channels, especially while those channels are being cleaned up.
Okay, let's pivot now. We have to talk about the brutal financial reality, the margin squeeze. Because honestly, this kind of overshadows everything else right now. The tariff shock, it's gotten significantly worse. Give us the hard numbers on that.
Yeah, you might want to sit down for this one. The incremental annualized cost from these new reciprocal tariffs. Remember, these are on top of existing mid-teens tariffs. That cost estimate has been raised. 90 days ago, they guided to $1 billion. Now, it's approximately $1.5 million.
Whoa, an extra $500 million. That's staggering. What does that mean for the full fiscal year margin?
The hit to FY26 gross margin is now expected to be around 120 basis points. That's nearly double the 75 basis points they guided before.
120 basis points, okay.
And this isn't some far-off problem. The pain is immediate. Management's Q2 guidance was the real cold water moment.
What did they say for Q2?
They expect Q2 revenue to be down low single digits.
Okay.
Maybe not catastrophic on the top line, but Q2 gross margin is expected to drop a staggering 300 to 375 basis points.
300 to 375, wow.
And they quantified it. Okay, so the 175 basis points of that pressure is purely from those new incremental tariffs hitting their inventory and supply chain costs.
Okay, so more than half the Q2 margin drop is just tariffs alone.
Pretty much.
And that massive margin drop is happening alongside higher SG&A too, right? Expected up high single digits.
That's right. Reflecting the investments they need to make in demand creation, the sport offense, supporting that 8,000-person realignment, it all costs money up front.
This is exactly what they meant by progress will not be perfectly linear.
Couldn't have said it better myself.
Yep.
And you see that unevenness clearly in the geographic results too. North America, as we said, is leading the way, but Greater China, still a major structural headwind.
What were the numbers there?
Revenue down 10%. Digital down a whopping 27%.
Ouch.
Yeah. The marketplace there is still super promotional. And management was pretty blunt. They said the turnaround in China will need significant investment in time. So the overall global recovery is patchy at best.
And we shouldn't forget Converse either. That's got its own turnaround story happening under new leadership.
Right. And management was explicit. Expect Converse to be a drag on both revenue and gross margin throughout all of FY26.
So multiple fronts where they're fighting profitability battles?
Absolutely. So if we try to synthesize this for you, the core conflict is really clear now. The market seems to be rewarding the tangible proof points that the strategy can work. Growing 20%, the EPS beat showing cost control is real, the wholesale channel bouncing back. But at the same time, investors are choosing to discount or maybe look through the immediate, very steep financial pain that's forecasted for Q2 margins. Pain driven largely by external stuff like that $1.5 billion tariff hit and the necessary internal cleanup.
Yeah, that act of discounting the near-term pain, it says a lot about investor belief in the long-term story, especially that digital reset. Organic traffic declining double digits. Management confirmed Nike Direct is not expected to return to growth in FY26. How do they keep the market believing?
By constantly reinforcing the long-term goal line, which is eventually getting back to double-digit operating margins. They stress the path there is complex. It relies on reigniting profitable organic growth, rolling out that running playbook to football, basketball. It relies on significantly improving the full price mix, is exactly why digital is suffering now. And eventually leveraging scale once these tariff pressures hopefully normalize or their mitigation efforts really kick in. It's a thesis based purely on execution from here on out.
Execution is the key word. Okay, let's step away from just the facts of the call for a moment and move into our This Is Not Financial Advice segment. This is where we pitch an outrageous but plausible trade idea born from the tension we've just discussed.
And we've got a perfect setup, I think. Exploiting that gap between the proven strategic success in one category running and this massive, hopefully temporary external headwind from the tariffs.
The valuation gap alone is pretty stark, isn't it? Nike stock has really underperformed its sector. It's down over 10% in the last year. Meanwhile, the broader consumer discretionary ETF, XLY, is up something like 22%.
Big difference. It looks like the market has fully priced in that $1.5 billion tariff cost, maybe assuming the worst case scenario without factoring in mitigation.
So the outrageous but plausible trade idea.
Okay, here it is. A long position on Nike Inc., paired with a short position on the broader sector ETF, XLY.
All right, a pairs trade. What's the core thesis?
The thesis is basically that the market has over-indexed on the headline tariff number, the $1.5 billion, without properly accounting for two key things. First, management's accelerated mitigation efforts. That means pricing adjustments, sourcing diversification, they're not standing still. And second, the potential operating leverage they could get from successfully replicating that 20% growth running playbook across huge categories like global football, basketball, and training. Those are massive markets.
So essentially, you're betting on their internal execution eventually overpowering the external tariff headwinds.
That's the bet.
And what's the catalyst? What makes this trade work timing-wise?
We're looking towards Q4 of fiscal 26. Betting on a sharp stabilization of gross margin by then. Why Q4?
Yeah.
Because by then, the really aggressive clearance activity from the previous year will have fully lapped.
Yeah.
The comparisons get easier. And the sport offense should theoretically be gaining measurable scale across more categories.
And that stabilization, if it happens, should cause that valuation gap versus the broader sector, the XLY, to close pretty rapidly.
That's the idea. It's definitely a conviction play, a bet that the value of the internal restructuring and innovation pipeline is ultimately worth more than the external cost shock from tariffs.
Got it. Okay, so just a quick recap for you listening. The strategic alignment, this sport offense, it is showing real, tangible results already, high growth in performance categories like running. However, the immediate journey for investors looks rough. It's heavily dictated by severe external pressures, namely that escalating $1.5 billion tariff cost and the ongoing kind of painful marketplace cleanup they have to do in places like Greater China and their own Nike digital channel.
And that brings us to the final provocative thought we want to leave you with today. Think about this. The stock traded up over 6%, 6.4%, I think, on heavy volume the day after this call. That's despite management explicitly guiding for a potentially devastating 300 to 375 basis point margin drop in Q2.
Right. Seems contradictory.
So is the market signaling something here? Is it saying that the intrinsic long-term value they see in the strategic realignment and the product innovation pipeline, is that already worth more than the full annualized $1.5 billion hit from tariffs?
Yeah.
Maybe investors are betting that the best defense against external cost pressures is a really strong internal product offense.
Definitely something to mull over as we wait for those Q2 results to actually roll in. Well, thank you for joining us for this deep dive into Nike's rather conflicting numbers. We'll catch you next time on Talk Tickers.